Shore Capital is a company that's been around since 1985. It's an AIM-listed company itself. It has a large stockbroking division focusing on high net worth and institutional clients, and it also has an asset management business. Within that asset management business, Puma Investments is the tax-efficient asset management strategy business, covering VCTs, EIS, and inheritance tax products, and we run approximately £200 million. The purpose of the product is twofold. First of all is to deliver a good investment return to clients. The second is to benefit from the inheritance tax benefits around the AIM, which everyone is aware of. We aim to build a portfolio of about 20 companies. Those companies should be over a £50 million market cap, so we focus on the upper end of the AIM. And what we're really doing is trying to build people a small cap portfolio of sensible, quality, good companies that can provide them a long-term investment return. We're not in the exciting end of AIM. We're not buying the racy stuff. We're not buying those kind of companies. We're very much avoiding those companies. The AIM has become home to a collection of largely family-controlled or with significant family stakes companies that are good quality with sensible balance sheets, which have long-term growth prospects. The first thing we look at is quality. So we're looking for companies with good margins, either absolutely or relative to their sector, high returns on capital, a track record of cash generation, and a track record of growing revenue. And we look at the companies as well in terms of what they do, whether they have a sort of an economic moat that gives them a certain niche within their market. So be it a brand or a market position or an absolute cost advantage, that provides them with that sort of barrier that means they can't actually have those high returns competed away. The other thing we're looking for is a company that's grow. So we're not looking for the very fast growing companies that may sort of blow up in investors' faces down the road. We're looking for companies that will be bigger 5-10 years from now. And then the other sort of part of our triangle is essentially valuation. No matter how good a company is, there is a price for everything, and we're not willing to overpay, and therefore we'll always make sure we're paying a sensible to fair price for the companies that we buy. We're fairly sector agnostic. I mean, sectors that we do like, consumer goods, sort of industrial distribution, small light manufacturing, those are the kind of sectors that we do like. But what we're really looking for, and what you find a lot on the AIM, is companies where they're in a niche. So they might get lumped in with support services, they might get lumped in with financial services. But in reality, they're the sort of 1 or 2 or 3 companies within a specific sector, which is a tiny little sector by itself, which allows it to earn high returns and deliver good cash generation that you don't get if you were to lump it in and say, oh, that's all just financial services, or that's all just support services. Probably very different from our competitors. We don't generally meet companies. The exception is we will meet a company when it first comes to the market, or if it's something we need to understand. And we can't get that understanding from reading the annual report. And to be honest, that's our first flag. If we can't understand something from reading the annual report, that makes us slightly nervous to start with. Our process is very spreadsheet driven. We have a model on every single company that is in the portfolio, and many, many beyond that. So most of the companies that are within our AIM universe, the sort of 300 largest AIM companies, we have models on probably 2/3 of those, and the long-term aim is to have models on all of them. And it is very numbers driven. We are looking at whether the company has a strong balance sheet. We are looking at whether the margins are high. We are looking at where the returns are. And most importantly, we are doing discounted cash flow analysis. We predict forward the cash flows. It is a bit of a guess, but we think that's the best way of doing it. And we come very much to a price target of what the company is worth. And then set against that, we do the normal traditional multiple analysis to see if that's not producing a silly result. A couple of interesting companies that have been in the portfolio a while, and I like to use these examples because they indicate just how large some of the companies on the AIM are and how good quality some of the companies on the AIM are. One is Nichols PLC, which is the maker of Vimto, the drink. They also own some other brands such as Levi Roots, Star Slush, Panda, and some other brands. They operate in 70 countries. The company's market cap is £500 million plus. It's got 25% EBIT margins amazing returns on capital employed. It's still got a big family stake, net cash balance sheet. It's the kind of company that has been around for, maybe 100 years is maybe stretching a bit, but it's that kind of length of time. And it's the kind of company we'd expect to be here for decades to come. And that kind of company is the company that used to be listed on the main market, the London Stock Exchange. Frankly, it came to the conclusion that it was never going to really raise any more money. It has family shareholders who need to get the inheritance tax benefits that exist on AIM. So for them, it was the obvious thing to do to move down. And there's a number of companies that have done that, and that perhaps makes up a third of the AIM portfolio as we run. I'm going to stick my neck out on this, where other AIM managers sort of tend to hedge around this. There is no bubble on the AIM. If there is a bubble on the AIM, it's in the few secular or perceived secular growth stocks. We know which the names are, who are on very, very high ratings. Those ratings may turn out to be deserved. My guess would be that some will turn out to be deserved and some won't be, but they're on 40, 50 times earnings. The family-owned companies are trading on multiples that range from the high teens to the low 20s for companies which have proven track records of growing over very, very long periods of time and have great returns and great margins. If you were to look at the average price earnings of our AIM portfolio, we would come in and around on a forward portfolio of around 12, 13 times earnings. That is not a high multiple for a portfolio. So the other thing that makes me feel it's not really a bubble is that if you were to look at how these things performed around Brexit, or Donald Trump getting elected in the US, or these kind of issues in terms of back and forth of the macroeconomy that tend to impact stocks, they're not continuing to rise whatever happens, which is pretty much my definition of a bubble. They are behaving as you would expect them to behave. The AIM stocks that have done badly post-Brexit are the ones you would expect to have done badly post-Brexit. The ones that have done well are the ones that have benefited from the currency. So that doesn't mean that something isn't expensive or that something isn't cheap, but the idea that they're all behaving in an irrational way is not the case. I think it is definitely more risky than an investment in large cap equities. The valuations are moderately higher, and the kind of companies that are on that market are potentially more risky. They're less globally diversified. However, on the other side, that's where the fund manager comes in to put together the correct selection of stocks. You can buy a collection of companies which are on sensible valuations, which are growing, which have net cash balance sheets, so even when you get it wrong, the risk of it being significant permanent loss of capital is reduced. And you can buy companies that have been around for decades. That is a very different world from the world when AIM started 21 years ago with 10 stocks on it. What is still very common on the AIM, and which is why our spreadsheet-driven approach is very, very important, is overexcitement, the next new thing, the story stock, particularly those kind of companies where the management come along, tell a great story to investors, everyone gets very, very excited, they go up 200, 300%, and then they go down 95%. Or 100% a lot of the time. There is still, and that's why our spreadsheeting process is very important. We don't need to kiss all the girls. We don't need to own every exciting story. We're more than happy to not own an exciting story if we think there's something wrong with the accounting, we think the profits don't turn into cash, all of these things that flag to us that there is something about that that's risky. Now, some of those will turn out to be great companies and we'll have missed them and we'll put our hands up to that. The vast majority will turn out to be pretty average companies with poor returns, and their share prices will be hit, and then a very few at the bottom will turn out to be dodgy or even outright frauds. But that's true of any stock market. That's not just the AIM, that's any stock market. Okay, well, I've been doing this now for 18 years, investing in small and mid-cap companies, both in the UK and across Europe. Our approach is very, very cautious. We aim to, first of all, try and return your capital. The second of all is to try and grow that capital over time. We're buying sensible quality companies, we're buying companies that will grow, and we're buying companies that are on sensible valuations. That doesn't mean that there won't be the occasional mistake, but if you are to look at the portfolio since we've run it, we've delivered in the two and a bit years since we've run it, a 30+% return, and that's against both an AIM stock market and a main stock market that's delivered perhaps about a 4% return. So we've got a proven track record of delivering this, and we have, a portfolio of companies which anyone looks down, they will be names they recognise, they will be valuations they understand, and there will be balance sheets that they can check, and will have, net cash positions or low amounts of debt.